I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a bit of a regular guest. Love having him on. He talks in sound bites so common people like me can understand what the heck is going on. I'm talking about Peter Schiff. He is the CEO and founder of Euro Pacific Capital, also Schiff Gold. Peter Schiff, thanks for joining us today on USAWatchdog.com.
Hey, my pleasure. Always great to be on your program.
I want to talk about that jobs number last week, 227,000. I mean, Trump actually went to work the day after he was elected president, so I guess part of that is to him. But is that happy days are here again, or are there some reservations in the 227,000 jobs supposedly created, in the last week report?
Well, not at all. Remember, a lot of these jobs are low-paying part-time jobs, and none of that has changed. So we're not creating the kind of jobs that we really need to create if we're going to make America great again. But I think what a lot of people are missing about the report, they focus on the headline beat. Yes, we created more jobs. But if you look beneath the surface again at some of the trends that could present a problem, at least for the Fed, we had a surge of people joining the labor force, re-entering. Remember, labor force participation has been declining. We have a record number of Americans who are not working. And now we saw a big influx of workers. And why is that happening? Are people now more optimistic? Do they actually think there might be some jobs out there and they want to look for them? Or are they finally, running out of money? Maybe they no longer have the luxury of not working. They've run out of credit, and now, circumstances are forcing them back into the job market. But if this is a change of trend, which is long overdue, right? If people are going to start coming into the labor force, then 220,000, 250,000 isn't going to cut it. I mean, that was okay when everybody was leaving the labor force, but we had something like 700,000 people enter the labor force, yet most of them weren't able to find jobs. That's why the unemployment rate ticked up. Both the U6 unemployment rate also came up, where the part-timers and people who are discouraged. So we're seeing a move up in unemployment, and labor force participation ticked up. The unemployment rate ticked up. And if we're going to get more and more workers coming into the workforce, unemployment is going a lot higher. Even if we keep creating 200,000 jobs a month, that's not going to cut it. And so the unemployment rate is going to go up. And if you look at what happened to wages were supposed to rise by 0.3%. Instead, they only rose by 0.1%. And they took last month's, December's, 4.4% rise, and they cut that in half to 0.2%. So in other words, between the 2 months, wages rose by 0.4 percentage points less than what they thought. And what the dynamic is, as you get this huge influx of workers into the labor market, they're competing for jobs. They're driving wages down. Employers now have more choices among who they want to hire. And this is happening despite the big increase in the minimum wage. Remember, a lot of states raised their minimum wages in January. And despite that, you have this anemic wage growth. And so I think for the Fed's going to see rising unemployment, stagnating or falling real wages. And that means the Fed is going to start to soften its rhetoric on rate hikes. Again, I said I don't believe we're going to get 3 rate hikes this year, but I think with rising unemployment and wages not going up, you've got all these Keynesian Phillips curvers on the Fed. They think inflation comes from rising wages. They're wrong. In fact, it's inflation that can cause wages to rise, not really the other way around. But I think if the Fed thinks inflation is not a threat because they have rising unemployment and no wage growth, they're going to be backpedaling. That's why you're seeing the dollar continuing to weaken despite the better than expected number. In fact, if you look at January, this was the weakest January for the U.S. dollar in 30 years. Gold prices are rising, commodity prices are rising, and for all the hype about Dow 2000, the U.S. stock market is pretty much the worst performing stock market in the world so far in 2017. If you adjust for currencies, the real gains are happening overseas, in foreign markets, in emerging markets, in commodities. It is very reminiscent of what happened when George Bush replaced Bill Clinton.
Oh, if you take a look at Dow 20,000, is that really any good marker for how the economy really is doing? I mean, the Fed might look at that and go, "Wow, we're front loading the system." As Richard Fisher said in the Dallas Fed, and we injected the system with cocaine and heroin. Are they going to continue to inject the system with cocaine and heroin, according to former Fed President Fisher?
Well, why would you expect a junkie to do anything else, especially when they haven't acknowledged the problem that they have? They still think this is all medicine. They don't realize how toxic it is. So, yes, of course, I expect them to continue that. And the fact that the Dow is at 20,000, that doesn't reflect a healthy economy. It reflects a bubble. I mean, the U.S. economy wasn't healthy when the Dow went up in the late 1990s during the tech bubble. It didn't reflect economic health in 2007 when the financial crisis was right around the corner. It just reflects financial engineering, bubble blowing. U.S. stocks are very expensive. Candidate Trump had it right when he called it a big, fat, ugly bubble. And it's bigger, fatter, and uglier now. And the fact that he's president doesn't change it from a bubble to a bull market. It's still a bubble. The air is going to come out one way or another. Either the U.S. stock market is going to crash or the dollar is going to crash. But either way, the real value of U.S. stocks is coming way down, and people shouldn't own them. They should be investing abroad. They should be investing in gold and commodities. That's exactly what happened when Bush came in after Clinton. Clinton presided over a stock market bubble and over a dollar bubble. People expected that to continue under Bush. Instead, the bubble popped. We had false prosperity under Clinton. We had false prosperity under Obama, even though it wasn't even that prosperous. It was still phony. But you blow up these big bubbles, and then they pop. And sometimes they pop on the Republicans. But it's not their fault. They're just inheriting the bubble. Although certainly Bush, when he inherited a bubble from Clinton, when that one burst, he presided over an even bigger one. But the culprit again was the Fed. It was the Greenspan Fed that caused the bubble under Clinton. Greenspan caused the bubble under Bush. And then when that bubble popped, then you had Bernanke and Yellen, who have inflated a far bigger bubble that was now passed on to Trump. And this bubble's bursting. And, it's interesting, Trump just last week, he signed some, they're going to try to deregulate a bit. They're going to try to roll back Dodd-Frank. And I could just see it now because we're going to have another financial crisis. And just you wait, the left is going to blame it on deregulation. Whatever deregulation Trump is able to pass is too little too late. There's a lot more that we should do. But it's not the deregulation that's the problem. It was the regulation that created it and the Fed.
Do you think that Donald Trump will actually force some companies into bankruptcy? I think Dodd-Frank is a scam. I think all that stuff is a scam. You know what I like? I like bankruptcy. You can do whatever you want. You do whatever you want. But if it blows up, your assets, you're incompetent, you're an idiot, your assets go to somebody else. That's what I like. I like capitalism and I like bankruptcy. Do you think Donald Trump will be presiding over a reorganization or a bankruptcy in the next even bigger, the biggest bubble ever? Do you think he will?
You mean a bankruptcy of the United States?
A bankruptcy of the bond market of the United States, of the Treasury market, or reorganization, call it what you like.
Well, the United States is bankrupt as far as I'm concerned. We're insolvent in whether we have the ability to actually repay the money we borrowed other than just run it off a printing press. Sure, we can print all the money we want, but then we destroy the dollar. But we don't have any way of repaying the debt legitimately with real purchasing power because we simply can't raise taxes high enough to repay what we borrowed, especially if interest rates return to normal. So I think it would be a good thing if Trump presided over a bankruptcy officially where we, defaulted on our debt and we asked our creditors to accept a haircut. That's what Donald Trump originally said when he was a candidate. And then when it kind of blew up, he backpedaled and said, well, we would never have to do that. We would print money. Well, that's the coward's way out. That's the politically expedient way out. That is bankruptcy. It's just bankruptcy by a different form. And unfortunately, I think the consequences of that type of bankruptcy, a massive devaluation that potentially could run into a hyperinflation, that is much worse for everybody, including our creditors. I think our creditors are better off with a legitimate haircut than having a complete crew cut with massive inflation.
Yeah, do you think that under the scenario coming up with the Fed and not being able to raise rates, they're going to, if you just painted the scenario where all these people are going to be coming into the workforce, wages aren't going to grow, tons of people will be competing for jobs, unemployment even so, if we don't create 400,000 or 500,000 jobs, a month that we'll have unemployment. Do you think the Fed is going to have to go back to QE? That's one of the things you predicted, that the Fed won't raise rates and they'll go back to QE. Maybe they'll even cut rates. What's your predictions for, down the road here in 2017?
Well, if they want to do the right thing, they don't have to do it. I mean, the right thing is not to do it, right? You said you like bankruptcy. Bankruptcy is cleansing. Bankruptcy is an important part of capitalism, right? I mean, if you make mistakes, the market wants you to go bankrupt, so you stop making those mistakes so that you free up resources to be reallocated and reinvested more efficiently to actually satisfy the desires of consumers. I mean, if you've made a mistake and you're not able to do that efficiently, the market wants to bring an end to that activity. And so that has to happen on a national level too. We really need to reorganize and restructure the economy. But I don't think the Fed has the stomach for that. So it's not that the Fed has to do QE. They only have to do it from the perspective of they want to prevent the bubble from popping. They want to blow more air into it. They want to try to delay the day of reckoning, which is how they have done it this far. So I expect the Fed to reverse course. I expect them to come back with another round of quantitative easing because that's all they have. It's just like a medieval doctor. They leech you and then you don't get better and then they leech you some more. I mean, they don't decide maybe the leeching isn't helping or maybe it's actually making it worse. It's like that's all they know. They're convinced that it works and so they keep doing it. So the Fed believes that everything they did in the past was correct, even though it was a complete failure. But because they don't recognize their mistakes, all they do is repeat them. So they're going to do that. And even if we do get some more quarter point rate hikes from the Fed, maybe we will before they reverse course. I still think they probably won't. But to the extent that they do, it's only going to be because inflation, even the way they measure it, is rising at a more rapid rate. So that even if the Fed hikes rates will still be lower than they were the last time they hiked because inflation will have accelerated more than a quarter point. So in other words, you could get a slight increase in nominal rates, but as real rates are actually declining. But at some point along the way, the Fed is going to reverse course. We are going to be back in recession officially, probably this year. I mean, what's the odds that we're going to make it through this first year without going through an official recession? I think it's pretty slim, especially if we do something to inhibit trade, if we have some kind of border tax or some kind of tariff, that's simply going to accelerate the move into recession.
What about the bond market? Michael Pinto wrote a book about the bond market bubble. Smart guy, I know your friends. He thinks we're going to end up getting some kind of a bond calamity, and we just had the worst January ever for European bonds. What say you?
Yeah, well, there's going to be pressure all around the world. I mean, look at the official inflation rates now in the Eurozone. Look at Germany. I mean, I think you're going to see a lot of pressure from the ECB to get from the Bundesbank on the ECB to start to wind down their stimulus program over there. I think that's going to be the ironic twist that surprises so many traders. What the view has been for so many years was that the divergence in monetary policy would be the Fed tightening while the ECB continued to ease. I think the reverse is going to happen. I think it's going to be the ECB that begins to tighten just as the Fed actually begins to ease, right? They're going to start preparing the markets for rate cuts and more QE, just as the Bundesbank the ECB is going to have to be removing the punch bowl. So that is going to be big for the currency markets. As far as the bond market, I mean, this bond bubble has been going on for a long time, right? And you've got a lot of people who have tried to short this bubble, and the cemeteries are littered with the carcasses of people who call the top of that bubble. And then it keeps on going up. But maybe we have seen the highs, but the Fed is going to come in. The Fed is going to try to keep interest rates as low as possible because we have so much debt. It's these artificially low rates that are the only reason that we can service it. So the Fed, I think, is willing to sacrifice the dollar to keep propping up the bond market. But I do think that even if we launch QE4, it may not have the effect on the bond market that prior rounds of quantitative easing. I mean, maybe the Fed will be successful in anchoring short-term rates, but they may lose control of the long end of the bond market. And certainly when it comes to corporate bonds or muni bonds or any bonds that are not being monetized, rates are going a lot higher. Because once inflation really picks up, and believe me, if they have to start fighting inflation in the Eurozone and the ECB has to take away the punch bowl and the euro starts to rise and other currencies start to rise. Look, the Australian dollar was up like 6% in January. That's a pretty good sign that commodities are going up. And if the dollar really starts to tank, and I think it's going to, remember, we finished last year, everybody was long the dollar. It was the most crowded trade ever, just like everybody was short gold at the end of 2015. And then we had a huge run in gold. We've already started out with a big move up in the dollar. The dollar moves down, commodities keep going up, oil is bottomed. We start to see inflation blow through the Fed's 2% target. So we get inflation 2.5%, 3% or higher. Interest rates are going to go up. People are going to figure this out. Even if the Fed is monetizing, even if they're buying treasuries, people are going to want out of our bonds. And you know, the last time when the Fed did QE, foreign central banks were there to buy up all the bonds. I don't think the Chinese are going to be there in a big way. They might not be there at all. The Japanese, the Saudis, the Russians. The Fed may have to do all of this on its own. They might have to print enough money to buy up all these bonds, which will just accelerate the inflationary move, meaning more people will want to get out of the bond market. So the Fed may be able to hold short-term rates down, but they may not be able to do it on the long end. And I think their efforts to do it will just create even more inflation, which will put even more selling pressure on bonds. But rather than being short bonds, I would rather be short the dollar, right, by being long foreign currencies, by being long gold, because in order to keep the air from coming out of this bubble, they have to sacrifice the dollar. That's the only way they can do it. And politically, that's what they want to do. And in fact, if you look at Donald Trump's got a weak dollar policy. He campaigned that the dollar was overvalued. He's already beaten up the Japanese. He's beaten up the Germans. Hey, you guys are not playing fair. You've got undervalued currencies. He's beaten up the Chinese. So when the dollar initially starts to fall, nobody's going to be worried. They're going to act like it's a good thing. It's not a good thing. It's going to be a bad thing that's going to get a whole lot worse when the dollar decline eventually turns into a crisis.
And I what's going to lead me right into gold and silver. I mean, so you're saying that this is the nirvana, the perfect positive storm for gold and silver, a massively declining dollar.
Yeah, you know, and gold had a great year last year. It gave back some of it at the end of the year. Gold stocks were the best performing stocks in 2016. They're already the best performing stocks of 2017. So I think the bear market in gold and gold stocks ended at the end of 2015. This is a new bull market. I think that the big gains that we got last year are just a small down payment on the gains we're going to get in the years ahead. And very few people are positioned properly. You know, even a lot of the people who are bearish, you know, they're just short or they're in cash. They're going to lose too. I mean, being short the market is not the way to go. I mean, yes, the U.S. market is way overvalued, no question about it. And if the Fed did the right thing, the U.S. market would collapse. But they're not going to do the right thing. They've never done the right thing. It's the dollar that's going to collapse instead. So that will put a floor beneath the U.S. stock market. It may even go up, but it's not going to go up in terms of gold. It's not going to go up in terms of foreign currencies. And so you want to own those other assets. And I think a lot of these emerging markets, they have been undervalued. If you remember what happened in the 1990s, everybody was worried about problems abroad. We had the Asian economic crisis, Latin America. People were worried about Y2K. I mean, everybody was buying the dollar towards the end of the Clinton term. Same thing in Obama. People were worried about Russia. They're worried about China. They're worried about the Eurozone breaking apart. The U.S. dollar has been able to be the beneficiary of all that nervousness, of all those worries. But I think that's going to take a back seat, just like it did under Bush. There's going to be some problems in the United States. I doubt it'll be a terrorist attack like September 11th, but something is going to happen. Maybe it's going to be something that's brought about by Trump. And, you know, Donald Trump isn't the cause of these problems. It's like we've got a giant, a wound that we got a Band-Aid on, and nobody is really looking at the wound because it's hidden by this Band-Aid, and it's been getting worse and worse and worse. And maybe Trump will peel back that Band-Aid, and we actually get a good look at how bad we're wounded. And then once we see it, I mean, there could be a reaction, but I think people are going to start to focus their attention on problems in America. And then when people are worried about America, and now people are trying to flee from the dollar instead of flee into the dollar, right? It's a big change in the dynamic. And so I think that we're positioned, you know, perfectly to catch this wave. It's long overdue. I mean, it should have happened a few years ago, but it didn't. But because it's taken longer, the imbalances have built up so much more that I think the payday for being on the right side of this is going to be that much greater because it took that much longer. And it shows you in investing, you've got to be patient. If you really want to make the big money, right, you see where the crowd has got it wrong. Anybody can follow the crowd and just do what everybody else is doing. right? But in the long run, you don't make money that way. You make money by figuring out where everybody is wrong, understanding where things are mispriced, and then you do the right thing. And then you wait patiently to get paid. You wait patiently for the fundamentals to catch up. And now people have to realize how wrong they've been. And so I think because this has taken so long and the bubble has gone so big, I think the people who were patiently doing the right thing the past few years, even though we didn't get to celebrate at the Dow 20,000 party, I think we're going to have the last laugh and do the most celebration when the bottom drops out of the dollar and reality sets in.
Just real quick, because you are a big picture guy, and there are all kinds of geopolitical war situations. I mean, Iran, ballistic missile testing last week, new sanctions, another terror attack in Paris, in France. Somebody wielding a knife, screaming at soldiers, more terror, war, rumors of war. What is your read on trying to navigate all the possibilities for terror and war, particularly in the Middle East and in Europe?
Well, I'm not a geopolitical expert, and I certainly hope that we don't have a war. We got enough problems. A war would just make it worse. And, sometimes politicians think that, a war is a good thing because, A, it can divert attention away from other problems, and it can rally people around, the patriotism of the war, and so you don't worry about it, kind of the wag the dog kind of theory. And then you have these Keynesians who actually think a war benefits the economy because of all the money we have to waste on military spending. Remember, Paul Krugman was saying that, we should just have a fake alien invasion so that we can spend all this money preparing for an alien invasion that's never going to happen, because he just thinks that spending money is going to generate economic growth and doesn't understand that if we have to prepare for a fake alien invasion, what are we not going to do? What resources, if we're going to divert resources to, building this, alien defense system, what are we going to give up to do it? What are we going to have to go without? Because it's we don't have unlimited resources. And if we're going to do one thing, that means we have to do without something else. And Keynesians just can't understand this simple concept. But I hope that we don't get into any geopolitical tensions. But to the extent that we do, it's only going to exacerbate the financial problems for the United States. It's going to put more upward pressure on our budget deficits, which are already going up. I mean, even if Trump doesn't get any tax cuts through, it's on autopilot now. And if we're going into a recession, we're going to go back to $1 trillion deficits officially, even if we don't get any fiscal stimulus. But I'm sure we're going to get something. And we may not get it as soon as people think. We might not even get the fiscal stimulus until after we're in recession, because that might, provide a catalyst to get it through. Otherwise, there's a lot of bickering and infighting and deals that have to be cut. And even if there isn't a recession, we might not get the tax cuts until 2018. But if we get some kind of fiscal stimulus, which involves a combination of more government spending, whether it's on infrastructure, on the military, building that wall, whatever we're going to spend money on, and of course, more money on Social Security and Medicare, because Trump says we're not cutting there. And then, of course, we have some tax cuts that end up reducing the revenue. Then these budget deficits are going to take off. If in addition to that, we had a war we got to pay for, it's going to be even worse.
Peter Schiff, thanks for coming on and taking us to school on your investing mind and what you think about the world. I really disagree with you. I'll tell you, you're very.
That's because you're a smart man.
Well, I don't know, maybe, but listen. Thank you so much. Thank you so much for coming on USAWatchdog.com. Peter Schiff, he is the chairman, CEO, and founder of Euro Pacific Capital, also Schiff Gold. The links to those sites, which there's free information and free stuff on there, about the company and articles and things like that will be on the site. Peter Schiff, thank you for joining us today on USAWatchdog.com.